You're listening to the Practical Tax Podcast with tax attorney Steve Moskowitz. The information contained in this podcast is based upon information available as of date of recording and will not be updated for any changes in law or regulation. Any information is not to be considered tax advice or legal advice and does not form an attorney-client relationship. Further, this podcast may be construed as attorney advertising. You should seek professional consultation for your individual tax and legal situation.
Well, welcome to another edition of Practical Tax with tax attorney Steve Moskowitz. Steve, there's, as you always say, there's so many ways that you can look at a subject and somehow taxes creep in there. And this is one of those cases today, I think, that when we look at it, our first guest is a leader in training and business development, but it gets even more interesting. Listen to this. He was a Yale grad and a grad from Columbia Business School. He also was a closer drafted in 2008 by the Detroit Tigers, a Major League Baseball closer. Anyway, Interesting stuff. After baseball, he was an intelligence officer for the Department of Defense. He co-founded a thing called Block Party, which changed the way tailgating partnerships are developed in Division I colleges, and got a direct commission into the U.S. Navy as a reserve intelligence officer, where he currently serves as a lieutenant. But we're talking to him today because he moved back to New York City after the pandemic and started One Range, which is an early stage workforce development tech company. That's a big intro. And his name is Steve Gilman. He's here with us on Practical Tax. Steve, thanks for being here.
Hey, thanks for having me. Happy Friday.
First of all, thank you for your service.
Indeed.
Yeah, really, indeed. It's interesting too that, I wonder if any of the acumen that you've picked up in the intelligence areas of your service have paid off in business.
Yeah, I'd hope so, but I'm finding new ways every day to translate some of the skills. Intelligence is specifically interesting within the military and civilian world because you meet a diverse group of individuals with diverse thoughts, right? So a lot of what we're doing has to do with cross-functional teams, getting different ideas into different stages, and then doing a lot of analysis, which plays into every little piece of what I do in the business world.
Sounds a little bit like what you do as well, Steve. I mean, obviously, analysis is a big part of it.
Thank you.
Yeah. Well, let me ask you both this question before we get into the details here. What is the future of work as we see it today? Let me start with you, Steve.
Work has a lot of aspects to it. There's obviously the business aspect, the personal aspect. This is the personal society. That's what a lot of people don't realize. And they think of work just as the business part. They don't realize how much socializing goes on. They don't realize how much it's all part of your life. And a lot of times when people retire, they find out they're so empty because all their social contacts are gone. Right. And a lot of people, if they identify themselves through their work, they just feel empty. And a lot of times healthy people, when they retire, they started becoming ill because there's just no purpose for them anymore. So there's an awful lot to work. Plus, besides making money, there's a lot of good you can do in the world.
Mr. Gilman, since you're both Steve 1, Steve 2, when you look at the future of work and everything from, learning and development and where that's headed, do you see a lesson we've learned, I guess, in the last 2 years from working remotely and having to deal with, it's like kind of conversations we're all having right now?
Yeah, I do. I think over the past 10 to 15 years, we've seen this huge spike, especially with knowledge workers and the use of software and technology, right? In the information age where people can be really productive with a few clicks of a button if they're doing the right thing. I think over the past 2 years, it's been accelerated, right? And we've been separated. So technology's become more of a mainstream instance. There's also been new technologies in the market. Most of the trends that we see as it pertains to future of work have to do with companies better empowering their people and the managers at the working level, right? The engineers, the sales, the marketing, and throughout. And so we've seen a rise in technology that allows them to do what they need better, easier, and more distributed than ever. So the future of work is kind of up for definition, but it definitely looks like flexibility, empowerment, technology at the core of what everyone does.
Well, here in the Bay Area, obviously, we're just a few miles from Silicon Valley. And you look at all the startups, and this is it's a question I've been meaning to ask you for a long time, Steve. What percentage of startup costs are tax deductible? In other words, if I'm kind of meandering, trying to figure out exactly what my product is and who my customer is, and I take a left here and a right there, but come back to where I want to be ultimately, are those little forays into the examination of who I am? Are they tax deductible?
Lawyer's answer. It depends, because ultimately, yes, you can deduct all of them, but the real question is, can you deduct them all in the initial year, or do you have to amortize them over a period of years? And that is an answer that's a lot longer than we'd have time for today.
Well, I mean, I've thought of this over the years of all the different software I've purchased, and the new software technology. Gets back to your bailiwick, Steve, and how they affect strategies. Many times it'll affect you in a way that says, like, that's not for me. So if I again, back to you, Steve, if I, for example, bought QuickBooks and I realized I'm not going to use this, it doesn't really work for me, it's still a deduction, and you take that and multiply it by 1,000 for an investment. Does that same still apply, or is that a nuanced answer as well?
Well, again, you take a look at the totality of the business, and it depends what's going to be best for you, but you have to make a determination. Is this something, and there's a lot of things where we actually have to make a determination. Can we deduct it all this year, or do we have to do it over a period of years? And if it's a period of years, what period?
Steve, have you noticed that that's some of the new strategies involving new technology? Do they mirror the old business model, or is there something brand new in here?
That's for me when it comes to strategies and how we're doing some of the tax deductions or the business models that are put out there now. Because
The whole, yeah.
yeah, so I think, and I'll marry this into how a startup thinks about it. So you mentioned a little bit of my background. This is my second company. This is pure technology. We provide software. The first 3-4 years of a software company's life, this goes for everyone on the East Coast, West Coast, and anyone in between, is worried about cash flow, right? Trying to get customer payments up front, doing whatever they can to defer. The books only mean so much. I can't say this too much in front of a tax attorney, but only mean so much because you do manage out of a bank account, which is different than they teach you in business school, right? So even if I'm given a huge discount on software to pay up front for a year, every founder, anybody in charge of the books at a pure startup is going to be looking to spread out those payments over time, even if it's a little more, right? Because it's getting
What you just said is very practical.
Yeah. Yep. And so when it comes to like taxes, right, my answer is always going to be, please, Steve, let me know what's the best for my books. Money in the bank for now, because I need to live to realize the benefit of any amortization.
Yeah.
And that's why we even call this practical tax, because we can cite chapter and verse from the books, but well, wait a minute, this is somebody's life and your spouse's life and your kid's life, and how do you want to live, and what do you want to do? And your kid doesn't want to hear it if they want the latest something for school, and you say, well, wait a minute, I could save taxes if. So the idea is planning not just for the dollars, but how do you want to live? And if you had a twin sibling and you were identical in all respects financially, what we did could be very different, because your goals could be very different.
Yeah, I'll give the example. You mentioned QuickBooks. Every startup company grabs QuickBooks, right? It integrates with everything for the most part. The amount that QuickBooks has to give you as a discount for an annual payment upfront is continuing to grow. It's probably 50% right now, right? Pay us 50% of what you would normally pay over the next course of a year for us to take your money up front. And that might continue to increase just because everybody's used to the pure SaaS model of spreading out payments, cutting things off if you need to.
Well, it's funny, not to sound like I'm something from Dickens Oliver. When we were kids, my mom literally did the thing with the envelopes, right? This is the money for this. This is the money for that. And Steve and I have talked about this before with, being able to handle cash flow and making sure with a startup that you're putting money aside, and you know that next quarter may not be this quarter. You have to be smart about that. And does that play out too, Steve, with like new startups that are just like maybe 3 or 4 people? Are they paying quarterly taxes even if they don't make a profit in those quarters?
So what happens is you have to take a look at always, are we talking about payroll taxes? Are we talking about sales taxes if you're in the type of business to collect sales taxes, income taxes? And that's what we were talking about last week with the envelope system, where I always tell clients, look, you need a minimum of 3 checking accounts, your business account, your tax account, and your personal account. So when you make X number of dollars, you need to put Y number of dollars in your tax account, because a lot of business owners don't. And they just, like exactly what Steve Gilman is saying, is they just go ahead and they spend what they have. And then we get into, well, wait a minute, what you just spent. Suppose, for example, they buy inventory. And they say, well, there's no cash left, so how could I have a profit? Well, wait a minute, get a little bit technical. That goes on the balance sheet. That's an asset. That's not an expense. But I don't have any money left in the checking account. Yes, but on your income statement, what you pay taxes from, you owe tax on that. So that's one of the things you always have to watch out for, because a lot of people, an awful lot of people, confuse cash flow with profit. And, Steve, I was a CPA before I was a tax attorney. So income statement, balance sheet, and assets and expense, that means a lot to me. But the typical business person is, but I spent the money. I thought I could deduct it. Well, wait a minute. If it's inventory, it's an asset sitting on the balance sheet. And yes, eventually you'll deduct it when you sell it. And the client says, well, wait a minute, I got rent due right now. What are you talking about? And how could I pay taxes? I don't have any money.
That, to me, that's fascinating. Is that one of the reasons why restaurants go down? Because of taxes, just that
it's not just taxes. The reason most small businesses go down is they just don't have enough money, enough capitalization. And the problem is, I know there's a joke about banks, but there's an awful lot of truth to it. That if you want to borrow money, you have to prove to the bank you don't need it. And that's why sometimes, businesses want to look at maybe government loans or maybe private loans with friends and relatives. But the bottom line is most small businesses have that terrible problem. They just don't have enough cash. And, most business, it's up and down. It's not like employment where you get a steady paycheck and you know that twice a month I get X number of dollars. In business, you could have a great month. We make lots of money. And then you buy lots of inventory, and the next month nobody comes in your store. You say, hey.
So you guys are telling me that the primary strategies for success go across the board, regardless of what your business is. Is that a fair assessment?
That's pretty good. I mean, there's obviously individual differences, but you have a lot of situations where businesses just share a lot of common characteristics.
Well, our next guest coming up is also a former, well, you're in reserve right now, reserve intelligence officer. Is that right? Does that mean you only have to think part of the time?
That's right. It's only a weekend warrior right now.
Yeah, I bet you are. We do really appreciate GetRange.com is the website, right? And
Yeah.
it's fascinating too. I love going to these sites again, especially by younger people like yourself that are in this, and you're right in the middle of this, yet you're also learning from, the acumen of 100 years before you and some of the insight to look forward as well. It's exciting stuff. Again, it's GetRange.com. Steve Gilman has been our guest. Again, thank you again for your service. And will you come back?
I will. I'd love to.
Thank you so much. All right. Be well, my friend. Bye-bye.
Pleasure.
Yeah, I tell you, it's fascinating to see how many people, and I wonder how much they learned from their military services too, about.
I would think a lot, because
A lot.
you learn leadership and you learn about getting a job done and putting personal problems aside and getting the job done. And that all translates into business.
All right, it's time now for Ask a Tax Attorney with Steve Moskowitz. So, Steve, what is signing under penalty of perjury? What does that mean?
That means that you can go to prison if you don't tell the truth.
You had me at prison. But when it says, we see that all the time under penalty of perjury when you sign. Most of us, I think of perjury as like making a statement. But when you sign something you know to be false, is that, in other words, if I sign a tax return that I know is false, is that perjury as well?
Well, it's a number of things, including, you could be charged with tax evasion. You could be charged with making a false tax return. You could be charged making a false statement. I mean, all types of things. But the bottom line is when you're talking about under penalty of perjury, if you don't tell the truth, you can be criminally punished for that.
That's Ask a Tax Attorney with Steve Moskowitz. All right, our next guest is one of the top loan originators in the mortgage industry. GP Theriot is also a captain in the United States Army and has 20 years of experience bringing people the dream of home ownership. And he gets this stuff really well, and he's nice enough to join us here on Practical Tax with tax attorney Steve Moskowitz. GP, hello, my friend.
Hey, how are you?
Doing great.
Yeah. It's interesting. We talk about, I was just in San Francisco the other day, and I was walking through the city, and I know it's commercial real estate, but it was borderline dystopian, Steve, to see so many businesses that had left the city. That contrasts greatly to the very few homes that we saw like in 08 or 09 that were empty. What's the difference between when you have commercial real estate that's empty and you find, people can't sell homes and, they have adjustable rate mortgages coming in and the whole thing starts to fall apart? GP, what is the major difference do you see there?
With ARMs right now with adjustable rate mortgages?
And in general, I guess that's why most of, most commercial businesses fail because the business goes away, like as in the pandemic, and they couldn't get their nut. But how does that apply? I mean, what happened in 08 and 09 was a unique set of circumstances. Can that happen again?
Yeah. Well, it's a great topic because we can talk about Bank of America just came out this past week with their 100% loan. But to talk about adjustable rate mortgages, back in 2008, 2009, the problem was that was the subprime market. And so you had people getting into homes already at a higher rate. It was a 2-year variable. I mean, the rate was locked in for 2 years. And then that's when the adjustable went. And that's when people they couldn't afford the payments. They were getting in properties they had no business getting into, the no doc loans, stated income, no credit loans. Well, over time, we've learned from that where now if you see what's going on in the market, so many people have so much equity in their home because they actually had to qualify this time, verifying income, putting a down payment, all the things that you need to have for a home. So, it was brought up today. I've got some concerns again because Bank of America, it's like, can we not learn from what we did in 2008, where what they're doing is going into distressed markets, lower income markets, and offering to give 100% financing, no credit check. They'll apply for their they'll cover their closing costs, a $10,000 credit. I mean, it sounds great. And look, I'm all for everybody to live the American dream and have home ownership. But if you don't qualify, you don't qualify. So you have no business getting a mortgage or getting a home ownership right now.
Were the banks part of that in that they knew that if the person defaulted, they could resell it and they could get, closing cost points, the whole thing again? Was that part of it?
Are you talking about what's coming out currently or in the past?
No. I mean, when you're giving arms to people that have, no jobs and no income, right?
Right.
And they're not going to, when the rates go up, they're not going to be able to deal with it. Was some of that intentional?
No, I think their true mentality was they have 2 years to fix their credit and to get it to where they can then refinance out of it. But that was not the case at all. I think a lot of it was, I think you had a lot of bad loan officers that were just trying to make a quick dollar and get everybody in. And there was, a lot of money was made back then on loan officers, which gave us a bad rep to begin with. So that's why it's critical to work with the right professionals that will, educate you, walk you through, go through the process of, do you qualify for a loan? Because I still see too many loan officers right now. They're not intentional to truly be an advisor and help people get into home ownership. Like I do with clients all the time that their credit might not qualify, but we come up with a plan. The military in me is let's have a strategy, let's have a plan, and let's execute and implement it so you're ready, prepared in the next 6 to 12 months, or even if it's 3 years to buy a home. But back then it was just the wild, wild west is the best way I can put it.
Hey, Steve, let me ask you a question about, I know there was a few years ago, there was legislation in Congress that took away some of the Californians' rights, well, not rights, but ability to take interest deductions on their off their income for their home interest loans. Has that changed at all?
Sadly, that's still in effect. However, there is a modification with a tax court case, because what happened was at one point we could deduct all our interest, credit cards, mortgage, whatever, unlimited. Then we lost the credit cards. Then it was down to $1 million principal on the house. Now it's 750. But what happens if two people buy a house? Two people that are not married to each other buy a house. The IRS said, well, you're still limited to the 750 for the house. And a taxpayer bought a house with his girlfriend, and he said, well, no, it's per taxpayer. It's not per house. They went to tax court. The tax court found that it was per person. So if boyfriend and girlfriend buy the house, they each have a 750. So that's $1.5 million together. And that applies to an awful lot of people, because an awful lot of people are unmarried and buy houses together. And essentially they've doubled the amount they can deduct.
Is there a hard number that we can tell people watching this about how much they can deduct from the interest they paid that year on their home?
Oh, sure. Because what happens is the hard number is you have a maximum of 750,000 per person. So if suppose a single person gets a mortgage for $1 million, he or she can only deduct on the first 750. Now, if boyfriend and girlfriend had the mortgage of $1 million, they each have 750, they can deduct all of it.
So you're telling people to get divorced before they buy a home is what we're saying here.
No, I'm saying that, it's funny.
Or get a
I've always
girlfriend
said that marriage is a very important tax event. And when I say that, people thought I was joking. They laughed. No, I mean it.
It sounds crazy, right? It does.
And that's the interpretation of the tax court.
GP, do you run into workarounds like this all the time in financing?
Well, I mean, when it comes to like tax questions, tax write-offs, I'm the smart one. I stay in my lane and send people to like Steve to talk about, hey, when you start talking about that stuff, you need to talk to the professional on that side with the CPA and the tax attorneys. But I mean, when it comes to different programs and stuff, yeah, I mean, there's all like, going back to ARMs, so just what mortgages, I do think it's a great product. And you're seeing a lot more of it happening right now because of, one, it's a lower rate than a 30-year fixed right now. But again, people have to understand what they're getting into, and they truly understand all the, what an ARM means.
Yeah, it's interesting that I sometimes I see, and this is, I guess this is the reason is because if you go on like iTunes or Stitcher and you look at the podcasts, the really successful ones are about business. I think people have really become more curious because it seems to me there's more opportunities today if you know what you're doing, right? If you have an idea, who to contact to help you through step by step. I saw this headline the other day, and it said how the student debt relief can improve your chances of getting a mortgage, and I would think that makes sense. So if you got for example, my son's fiance had about $20,000 in debt, and they're both starting out, and she got about 3/4 of that wiped out, and of course that improves her books. Is that the kind of thing that can make a big difference to a loan officer?
Oh, absolutely. I mean, debt can kill a deal. So I mean, the two things that we look at first off is, one, what's your credit score, and two, what's your debt to income ratio, to truly see what kind of price range can you afford based off your current income. So debt, I mean, the credit report plays a huge piece for me. I can tell you right up front if I can qualify somebody just based off their credit report alone.
I remember and this is years ago, and I grew up in an apartment, so I didn't have this experience, right? I didn't live in a house till I was 30. But I remember hearing how you could deduct the depreciation of your home despite the fact that it was appreciating. Steve, that sounds to me like either a scam or something that,
It's not a scam, but you'd mix some concepts. If it's your personal home, there's no depreciation for you.
Really?
You don't get to deduct.
There used to be?
On the personal residence. No, it's always business property.
Okay.
But suppose you have this situation. Suppose you buy a rental building and you buy it for $1 million, and the next day it's worth 10 million. Even though it's going up in value, you still get to depreciate it. And all depreciation is and you're depreciating the cost of the building, not the cost of the land, all depreciation is letting you deduct a portion of the house over a period of years. Now, there's modifications on that because we've talked about cost segregation analysis, where we send an engineer to the property and he or she says, well, you know what, this part, because basically, if you're talking about rental property, we're talking about depreciation over 27 and a half years for residential and 39 years commercial. So the engineer says, well, this part is in fact 27 and a half or 39, but this portion is 15 year, this portion is 10 year, this portion is 5 year, and this portion you can write off this year. So you can greatly accelerate the depreciation. We could do a whole show on that. But the bottom line is the fact that the property is becoming more valuable has nothing to do with your taking a tax deduction for what you spent.
GP, can you still assume somebody's loan? I remember hearing about that when I was younger. Is that still out there?
The only thing that you can assume a loan is on a government loan. So a VA loan right now could be very attractive to people because they can't assume that. But on a standard Fannie Mae, Freddie Mac type loan, you cannot assume it. No.
You mentioned earlier, before we let you get out of here, I want to hear your thoughts on this. The obviously what happened in 2008, 2009 is still in some people's heads, although as you mentioned before, with Bank of America and the non-QM loans that are out there that seem better than the ninja stuff from, the Great Recession. Do you get this feeling though, that moving forward that we've learned a lesson about that and maybe we're a little more cautious about how we sell homes to people and maybe, I'll be honest with you. I grew up in apartments my whole life, and there was no guilt about it. There was nothing wrong renting an apartment. Steve, you spent a good chunk of your life too that way when you were younger, renting. It's not, I know people that rent their whole life. My mother rented her entire life. Lived to be 98, and there was not. Is there time maybe for that kind of message to come out again? It's just like it's okay if you don't have a home. It doesn't mean you're less of a person. But I can't see a realtor saying that. But right.
Well, I'll be honest with you. It's almost a two-way street now. Rental rates right now are going up just as fast as mortgage rates.
No, you're right. You're right. My house next door, they're paying more, and the people that are renting it, I know it's about $2,000 more than the nut. And I'm thinking to myself, God, if they could just buy a place, they'd be saving money. Yeah, I get it.
That's just it. What you have to put in perspective is that rental, they can increase your rental rate at any time, even though let's say you have a 12-month lease, a 3-month lease, or 3-year. That's going to go up every time, where at least on a mortgage, you're locking that in. If it's a 30-year fix, you know what your fixed payment is for 30 years. And when the rates do go down, you can always refinance it to a lower rate. So right now, we're consulting clients on get comfortable with the payment. Don't fall in love with the home and just date the rate, because we can always refinance you, which I truly believe we're going to see rates go down in the next 24 months or less. The data's shown, the history's shown it will happen.
Steve, what should somebody ask their tax attorney as they're heading into escrow or, into the first part of a purchase of a home? What's something important for them to know other than they can just afford it? Are there other aspects to that things that we're missing?
Well, sure. And again, it depends on the individuals, because the first thing when I talk with a client is you tell me what you want to do. You tell me your goals and aspirations, desires, and I'll tell you the best way to do that tax-wise and financially. Because somebody might say, well, you know what? I want a really small home because I want to, and this is true with a lot of millennials. A lot of millennials are talking now, they would rather have the experience than the material thing. So suppose you make X number of dollars and you could afford a big house. Well, you might say, well, I'd rather have a smaller house and travel the world. Somebody else says, well, I plan on having 19 kids and I want a big place with a giant backyard. Somebody else says, well, I can get more home by moving further out into the burbs and I don't mind the commute. Somebody else says, look, I work a lot of hours and I'd like to walk to work. I have a really short commute. So again, before we get down to the numbers, it's what do you want to do in life? Then we'll figure out the numbers. And that's so vitally important.
Last question, Steve, about that before I forget. If I have to borrow money for an extension or a home repair, is that interest deductible since it's my home, or does it only a loan for the home?
So what happens is if you're talking about expenses for your personal home, that's not deductible. However, let's see what you're doing, because you might be adding to the basis of the home, and when you sell it, decreasing your capital gains and saving taxes that way.
Got it. GP, I know you wear that red for Thursdays to honor veterans and
Fridays.
It's meant Friday. Today's Friday. Yeah. All right. And thank you again for your service and for your time today on the show with us. Really appreciate it.
Thanks so much.
Absolutely. Yeah. The red stands for Remember Everyone Deployed. Red Fridays is what we call it.
All right. Well, we'll send people to your website at the end of this again, but it's, I call it, you can just say it, the Riot Mortgage Team. That's how you spell his last name. That's all right. Well, good to see you again. You be well. Okay. Thank you so much. Again, GP Theriot from the Theriot Mortgage Team. See, Steve, that blows me away. There's like so many, like I never would have thought to ask questions at our closing our homes before about the tax advantages with the tax attorney. It can never hurt, right? Before you go into that.
Of course, you should always ask.
Man. All right. Great. Another great practical tax episode. You can find these on YouTube or go to MoskowitzLLP.com with our tax attorney, Steve Moskowitz. I'm Chip Franklin. We'll see you next time.
You're listening to the Practical Tax Podcast with tax attorney Steve Moskowitz.